Right, well, good afternoon and welcome to the Skadi webinar. My name's Claire Ostrich. I'm the business manager here for Skadi, and Damien Taylor, who is our Director of Development and Training, he will be speaking to you today on the webinar. He's going to be looking at how equities and ETFs trade and looking at how they've been trading or how they've been affected during lockdown. The webinar is going to be recorded, so you can have a copy of this afterwards. And during the session, if you want to ask any questions, if you just click onto the Q&A and pop your question in, and Damon will answer any questions at the end. I'll now hand over to Damien. Thank you.
Thanks, Claire. Thanks very much for that. So, welcome everybody. Thanks for joining us today. So I'm just going to give you a quick rundown of how products trade, specifically products I've traded over my career. So specifically equities and ETFs, how they trade in a sort of normal market conditions, and then what has gone on during the lockdown phase that we've seen ourselves in, and what issues this may have raised for control staff and for other people looking at this, such as lawyers, during this period of time. So 1 second, there we go. So just a quick rundown on Skadi. We were founded in 2012, and we are focused specifically on business integrity. All our employees have either worked in trading roles or general front office roles in trading, sales, or structuring, possibly market risk or capital markets. So what we do is we bring that first-hand front office knowledge, and use that with control functions, with investigation teams, with law firms, to help them get an understanding of what it's actually like to be working at the coalface of a financial institution. We also do expert witness for litigation support for law firms, and that has been an interesting area of work that we've moved into in the last few years or so. So just moving on to the meat of the presentation. The actual mechanics of how these products trade is more complex than it appears on the surface. I think you can watch CNBC or you can read in books about how equities trade, etc., and understand maybe from a theoretical basis, but actually how they trade in the bank themselves on a trading floor can be slightly different from how people would expect. And a deep understanding of this, and hopefully you will have this at the end of this, or a better understanding of this, will give you a good look through into how issues could arise, I mean, generally in normal market practice, and also in these very strange circumstances we found ourselves over the last few months. So as said at the beginning, I'm going to look at equities and ETFs. ETFs obviously very similar to equities, but there are a few wrinkles within them that can bring up some issues. Just a bit about myself. My name is Damien Taylor. Before joining Skadi, I've worked in the city for 24 years. I started as an analyst looking at what's known as closed-end funds, of which investment trusts are a subset. I then moved on to become a trader, first of all trading in those closed-end funds and investment trusts, and then moving on to trade general equities and futures in both an agency and a proprietary basis. So an agency basis would be trading on behalf of the clients of the firm, taking orders from salesmen, then working those in the market and looking to take small amounts of commission for that business, or proprietary, actually using the bank's capital to take positions to attempt to make more money for the financial institution. In my career, I've also worked as a hedge fund manager, so I've sat on both sides of the fence, as it were. I've worked in both the buy side and the sell side, so that gives me an interesting insight into both how those organizations work from both of those perspectives. As mentioned here at the bottom, the bulk of my career I've been trading on equities, but actually in the last 10 years or so, I've traded a lot of futures and options, and over my career I've traded in FX, converts, investment trusts right at the beginning of my career, and more recently ETFs, hence I can tell you something about that later on in this presentation. So moving on to equities. So as you're, I'm sure, now aware, equities trade all electronically. The days of the trading pit have long disappeared. Very few trading pits left for many securities around the world. But equities moved the electronic way over 20 years ago now, really. The bulk of the exchange has moved on onto electronic means. The electronic order book is based on a time price priority. They are efficiently priced. There is decent liquidity in a lot of the names, and very transparent. It's very easy to track prices for any period of time, down to the millisecond, in fact. And this is useful nowadays for looking at things like transaction cost analysis for how people have traded over certain periods of time. They trade across multiple exchanges, and actually this is something that not everyone is aware of. The assumption that, for instance, Vodafone in London trades just on the London Stock Exchange is outdated. Post MiFID I, there was an explosion in alternative venues, and many equities now are priced and traded across multiple venues. And in fact, the London Stock Exchange, I think, now accounts for between 30 and 40% of a bulk of the equity trading now here in London, for example. As we are all aware of, as computers slowly take over the world, a large proportion of the volume is now driven by algorithms. A lot of algorithms I've used over the years, simple things like VWAP algorithms. So you you'd put an order in to buy a certain number of shares over a certain period of time, and an algorithm would look to match what the historic norm for that trading pattern would be, and slice that order up over a certain amount of time. So that is very computer driven now. You're giving the computer the instructions, and then it will go off and trade pieces of that as it sees fit. Within the equity world, there are platforms that people use to advertise flows, advertise indicated flows. They might go out as a buyer or a seller of a certain name, or actually to advertise volume that they've traded, to attempt to hook in other clients, other customers to trade with them. These tend to be known as indications of interest, and the major platforms such as Bloomberg of this world have large amounts of data on this. If we move on here, this is just a standard look at an order book, courtesy of Bloomberg. This is looking at Vodafone here in London. Snapshot taken a few days ago, in fact. I think it's trading a bit lower than this. But if we look here, we can just get a great recap of what is going on in the stock. So here on the left-hand side are the buy orders, ranked by price. As you can see, the top buy is there, 126.44, and then reducing down this is all we can see at the moment, that's about the top 10 price points we can see in that order. And as you can see here on the time side of things, anything with a later time will be higher up the queue. A later time will be lower down the queue. So if we look here at, for instance, the 126.40, the price point, the first order is the oldest order there. So people can't jump ahead of that in the queue. They would have to sit underneath that. And here on the other side, we have the sell orders. So if you decide that you want to sell a stock, you can either sit here on the offer and wait for someone to take you, or you can aggressively cross the book and hit the bid, obviously getting yourself a slightly worse price. Down at the bottom here, we can see where the volume of this stock is traded. So in fact, as I was saying earlier, this piece of the pie down here showing 32.7% is the amount of Vodafone that is traded on the London Stock Exchange. And then these are the other exchanges that it's traded on. So TQ is turquoise, IX I think is Chi-X, and XV I think is the blocks that have gone through in this trade. I think it's a CBOE exchange, and these will be block trades that have gone through in the exchange away from the main book, but within the price of that. So this gives you an overall summary of what's going on. You can see that on the top line, and then here we can see the time and sales and how the shares have been, the distribution of where those shares have been traded. So the mechanics of an equity trade. So this if we can have an understanding of this, then we can start to look at where issues might crop up in the environment that we've been in, and in general normal environments. So we might see an order generated by a portfolio manager to, let's say, buy 10 million Vodafone, sticking with the stock we were looking at, maybe taking place with a conversation between a portfolio manager within a large institution and a sales manager within a bank. And if he decided to execute that order, he would pass those instructions through to a dealer, within his firm, and that dealer would then look to give those instructions through to a sales trader, or quite often cutting the sales trader out might electronically route that straight to the trader. And then the trader would have the option to how to execute that order. So he could either look to maybe put it into an algorithm. 10 million Vodafone would take, I would guess, probably 5 or 6 hours to trade on the London Stock Exchange under normal conditions. So it might look to be split that over the rest of the day, or it might be an algorithm over a certain number of days. You might be just looking to slowly build a position without leaving much of a footprint in the market, which could be an instruction given by the PM themselves through to the dealer, through to that trader. Or it might be taking place as a discussion between the trader and the PM to try and work out what would be the best way that they would like to go about it. The trader might be asked to, or might want to, go on risk to that. So they might make them a price in the entire size. They'll go, okay, I'll sell you those 10 million Vodafone. Looking at that screen before, I think they were 126.50 on the offer side. They might be offer 10 million at 127 to get the entire trade done, and that position would therefore flip immediately within the bank to a back book, and quite often these back books would be run off over a number of days or even weeks. As they build up in position size, they would then look using internal algorithms to unhedge that position slowly throughout the days or weeks they would look to do that. The trader might contact an interdealer broker, an IDB, to see if there are any offers out there in that stock from other counterparties anonymously that they could look to hook off, or they could get the rest of their sales force on the phone, picking up the phone to other clients to see if they could find the reverse side of that trade. So that is a general overview of how an order would flow in the front office within a bank. Obviously, I've cut off anything on the back office of this side of things. Is much more about how the execution would take place at the front office of the bank. So issues to think about around this order. Will the firm? Well, the firm is obliged to provide best execution, and this is obviously looking at one order on its own. But if firms are trading hundreds and thousands of orders in hundreds and thousands of securities at any one time, they have to ensure best execution for this. And given the markets and the scenarios we found ourselves in the last few months, it's very interesting and important to ask whether best execution will have been adhered to. Certainly, we know that when lockdown hit, and it all hit very quickly, firms were forced to send staff home and get executing as if markets hadn't changed at all within a quick period of time. They had to still ensure that best execution was taking place within these markets. Likewise, as people have been forced to work from home and not in the same institution, have there been any breaks in the communication trail or in the audit trail? One of the great things about equities and the fact that they are so transparent and they all trade over a network called FIX, which I'll come on to a bit later, is that the minute an order has gone in, you can trace all the dependents and all the fills that have occurred within that order. Now, with people working from home and not possibly on secure networks, have orders been input immediately when they were received? Has there been a delay getting an order in? And if so, that might cause problems with an audit trail when you're trying to piece together whether an execution has been executed with best execution in mind. Another issue is information leakage. And actually, looking back at that graphic I had on the page before, there's always a big discussion between clients and brokers about keeping their orders secret. They don't want to be looking to buy these 10 million Vodafone, but then this order gets flashed around the whole market, and suddenly Vodafone starts to move away from them, and they haven't managed to deal in that stock at all, and suddenly the price is 2-3% higher than where they were looking to do that. So the information leakage is key, and actually, as people have worked from home, the chance of information leakage will have increased, because our orders being broadcast across unsecure channels or across things like WhatsApp to groups of internal sales traders, etc., the chance possibly of that order getting leaked will have increased. Looking back at one of the options available to traders, the algorithm option, and we fortunately haven't seen much of this in recent years, but going back to 2012, I'm sure some of you may recall Knight Capital was blown up by algorithms being misused, as in someone put an algorithm in a few names that was supposed to be traded over a certain number of days, and the order went in and was executed over half an hour, destroying some stocks and basically putting Knight out of business due to the massive losses that they occurred for this. So people need to be aware of the algorithms they're using. There's certainly when I've been using algorithms in the past, you have to double check, triple check, putting inputs in, making sure you've got time zones right, etc., etc. if you're splitting an order over a certain number of hours, and making sure that this all happens seamlessly. Now, this is certainly, I would say, easier in an office where you're on big networks and you have decent computer power at your disposal, rather than trading from your home desk, possibly linking through into a secure network at the bank. But there might be delays in putting orders in, screens might be a bit small, etc., etc. So we need to be on top of these things if we're looking to use algorithms to trade. Front running, also an issue. That's also tying back into the information leakage bit of this. The banks have to ensure that there's no front running is taking place. And with disparate desks split across working from home environments, this is much harder to police. Also, as we came into lockdown, we've got to be aware of conflicts of interest and restricted lists. Things like restricted lists, very important. Certainly a lot of corporate activity has taken place over the last few months as companies have dashed to raise cash in this environment. Have restricted lists internally been kept up to date? Quite often, if a stock goes onto a restricted list, for example, a firm is unable to make a market in it. If a list isn't up to date, then there could have been a conflict within that. So we need to make sure that restricted lists were kept up to date and adhered to. Likewise, corporate actions departments. They are vitally important to what goes on within a bank. If a stock's having a stock split, for example, that needs to be fed through all the systems before it is occurring, the night before a stock would split. Otherwise, somebody might look to execute an order at completely the wrong price. For instance, I think Apple is about split 4-for-1. If you're looking to put in an order at 2,000, when actually the price the next day is going to be 500, that is going to be a problem. Remember, just as I was saying earlier, the example I've given before is just on one stock for one order. Banks are dealing with multiple thousands of orders at any one time, and they have to ensure best execution for all of them. And as I've talked through that list, the implications of working from home for all of these can be quite significant. I know that a lot of things, and the regulator was keen to allow some controls to be relaxed to try and keep businesses going as usual, but we're now well past that point and now used to this environment. And the regulators are very keen that normal process and services is resumed, and to make sure that working from home doesn't stop normal processes of a bank taking place. Just a bit on what goes on underneath the hood of equities, much more on the settlement side of things. They settle normally in local depositories, i.e. they would settle, a UK stock would settle in Crest, a US stock would settle in DTC. If not, if you're trading, for instance, Vodafone, but settling it in US dollars, that would settle in Euroclear. Most equities now settle on a 2-day time frame, T+2 as it's known, except for new issues. And as I mentioned earlier, the FIX protocol, which stands for Financial Information Exchange, is the de facto messaging standard for pre and post-trade communications, and allows a lot of straight-through processing to take place in the equity world. Excuse me one second. Moving on to look at exchange traded funds, ETFs. They trade on the order book exactly the same as equity, but the underlying mechanisms are slightly different. They have been in a huge growth area for the last 20 years or so. I think there are now well over $7 trillion worth of assets in the ETF space. And they differ from other types of funds. They're a sort of hybrid type of structure. They take some of the advantages of closed-end funds and also open-ended funds. So a closed-end fund would be a classic investment trust type structure here in the UK, whereby a fund raises money to invest in, let's say, the emerging markets, raises $100 million. It then has that $100 million to go invest as it sees fit, according to its mandate. But the shares of that fund trade freely on the market. So if there are more perceived sellers than buyers, the price of that fund will trade below its net asset value, and vice versa. If there's great demand for that thing, it may well trade at a premium. An open-ended fund, on the other hand, you would trade direct with the manager themselves, but on a daily basis only. So this is a sort of typical mutual type fund structure in the States, in the United States, where you would look to buy a tracking fund, let's say, but you would only be able to trade at one point during the day, whereas an ETF takes two of these. So an ETF trades freely on exchange, minute by minute, second by second, which is like a closed-end fund, but also it has the open-ended structure whereby at the end of the day, what's known as an authorized participant can create or redeem shares in that ETF for the underlying assets that the portfolio is tracking. So there is a balancing mechanism whereby the premium or discount will rarely move away from the net asset value of the fund. What an ETF has done and why they've been so successful is they allow a great broadening of the mandate of many investors. So whereby if you could only, for instance, invest in equities, you might be able to just buy shares in the FTSE 100, et cetera, et cetera. ETF that's suddenly now tracking oil or gold or a basket of US pharmaceutical stocks, for example, would allow you to broaden your mandate, but still sticking within an equity type strategy. One thing to be aware of with an ETF is the difference of some of the underlying structures. The big ETF, the biggest ETF in the world, which I think is the SPY ETF, which tracks the S&P, would be a physically replicated structure, as in every time you are buying one share of that, you're in fact buying the 500 shares equivalent in their weighted basis of the S&P. So you can, if you have, for instance, £100,000 worth of that ETF, you can in fact exchange that for all the underlying components, and the ETF is bound to track the underlying index by buying or selling the exact number of equities to balance that out on a daily or minute by minute basis, whereas a synthetic ETF will be based upon a structured product written by an institution. So you could buy a DAX tracking ETF, for example, that will have theoretically lower tracking error because it's not having to pay commission to buy and sell these equities or the underlying equities on a daily basis. But by buying a synthetic ETF, which would be trading against a swap written by that counterparty, you are taking on that counterparty risk within that. Talking about here the mechanics of ETF trading, they trade in a very similar fashion to equities on an order book like the one we saw earlier. However, especially in Europe, not so much in the States, where the ETF market is much more advanced. Liquidity on the book can be quite misleading, and I know this is something that regulators are looking to try to improve, to try and increase uptake certainly from retail participants. A lot of business is transacted off book in ETFs in Europe by market makers and the authorized participants I was talking about earlier. So they would look to make you a price in, for instance, a DAX ETF on screen, there might only be 100 shares or so on the offer, but because the underlying index is very liquid, because for instance in the DAX there's a very liquid future that exists on it, the ETF market maker can offer you a very aggressive price and size at where it's trading on the book, even though there might only be 100 shares there on the book for you to theoretically lift. They are big market makers outside of the banks. Some of the names I've listed here: Optiva, Jane Street, Flow Traders, and Susquehanna, who will price up the bulk of the ETFs that are listed on exchanges, and who use powerful algorithms to be able to price up large size in these ETFs based on not the liquidity that you can see on screen, as I've mentioned, but the liquidity of the underlying instrument. So, if you're looking at something that has a very liquid future, for instance, maybe a gold ETF or an oil ETF, although a bit more on that later, they will be able to price up, $10–20 million worth of an ETF at a very aggressive price, based off the fact that the underlying instrument is very liquid. What would tend to happen from the bank's point of view, they tend to, and I've seen these myself, they will offer dedicated screens to clients that will allow them to trade electronically, and these things work along something called an RFQ, a request for quote model. So you as a asset manager might put in, you want to buy $10 million worth of a pharmaceutical ETF, and the algorithm will spit back a price to you based around the price that it's trading on screen, and then you can decide with one click to buy or sell that if you require. And this is one of the interesting tricks, I suppose, you could use with an ETF. It's a way that people have used to build positions under the radar or synthetically. I will just leave this on screen and talk through it rapidly rather than getting too slowed down by it. But there's a way, if you wanted to build a position in a stock, for instance, looking at this, if there was a stock in a 10 equally weighted ETF that you wanted to get a long position in, you could buy the ETF and short the other 9 components against it, thereby creating a synthetic structure that would track, in this case, the share price of D, I've called it here. And in fact, due to the creation redemption process embedded within that, you could run that synthetic position for a while. And then in fact, if you wanted to take delivery of that stock D, you could redeem the ETF to be delivered the 10 underlying shares. 9 of those would cancel out the 9 short positions you already held, and you would be left with a position in one stock, the stock D. Now, I've seen this trade done many times by people looking to, a bit like I was talking earlier about people being worried about information leakage. You could build a position in a stock synthetically without leaking that what you were intending, and that would allow you, therefore, once you collapse the structure, to have a position. Then if you were looking, for instance, maybe to looking at M&A activity and that or whatever, you built a position in it without sort of notifying the market what you were doing. And this is, I was talking about this a bit earlier about USO, about oil. And this is one of the issues that we have seen in the ETF market, especially ETFs that track or purport to track futures markets. And this is the performance of the large oil ETF called USO out in the States so far this year, or actually to the end of July this year. And it shows you what happened when we had that massive sell-off where in fact oil went negative. One of the contracts went negative, the front month contract. Since that low, people who think they might have had oil exposure from the ETF in this orange line have actually not partaken in anything like the rally that we have seen in oil. And a lot of this has been driven by the fact that the fund itself got so large that it was a forced seller of the front month contract, which is what it would normally hold, and a buyer of the next month contract or next quarter contract, where there was a massive premium between the two, a bit massive spread between these two prices. And in fact, this has continued to happen as the oil contract has moved forward. So an investor in USO has not partaken in anything like the performance that they would have thought. And this is one of the issues that the ETFs need to deal with, in a way that people have to understand, or have to look very closely at the prospectus of an ETF to understand exactly what they're buying. I think a lot of ETFs might hold themselves out as being a simple gold ETF or oil or whatever it may be, but people need to have a close look at what the underlying actual structure is. And a lot of the problems with this were caused by the fact that, because people knew that USO was such a large player in the futures market, they were looking to basically front run that position. And they knew that they were a forced seller of near month buyer of far month contracts, and they've wreaked this damage on the ETF. So issues to think about ETF trading, especially in the last few months of what we've been through. They come across all the standard equity issues that I've talked about: best execution, for instance, information leakage, but also you need to be aware of the deviation from the benchmark / NAV, which is what we were showing in the chart before, and also what has happened in this in these strange markets, as well as obviously us being forced to work from home, traders being forced to work from home. There's also been a tremendous amount of volatility in the market, and in fact, as the markets were selling off, some ETFs did have a number of days where they moved to significant discounts to the NAV, specifically in a lot of bond ETFs. Bond ETFs obviously suffering from the problem that a lot of the underlying assets, the bonds themselves, are a lot less liquid than the ETFs themselves. So as there have been huge sellers in the market, as people have raced to get out of positions, they've been forced to a significant discount, and even the authorized participant balancing mechanism has not been enough to prevent this. Now, that may be all well and good, and people would argue possibly that is just markets behaving rationally and pricing things correctly. Now, but if you think about it from a investor's point of view, if you have bought exposure to, for instance, USO or oil, as it were, or gold, and actually you have been sold out of a position at a discount to where the underlying was trading in a product that is supposed to track its underlying, there could be cause for concern in that. And actually people will have to go back and look at what happened exactly during those volatile times earlier this year to make sure that things did trade normally and sensibly. And also, this is another thing, looking at how you measure how good your execution is against your benchmark. So a lot of asset managers will look at transaction cost analysis to make sure that the brokers that they're using are adhering to best execution, to looking to trade across different markets if there are better prices available. And with an ETF, the issue with this is because the main tape can be very liquid, and across all the listed exchanges, there may still be a very few number of shares traded, except when they trade in a block. You can find that you have got your benchmark for your transactional cost analysis can be quite an issue. And if we have a look here, go back to the initial slide that I put up with the structure of how a trade takes place in a front office environment. You need to think of all the breakpoints that can occur. In fact, every single arrow here, especially in this lockdown type scenario, could have been a potential breakpoint, specifically because of communication issues. When people moved into lockdown rapidly, were people still on recorded lines, for example, or were they on mobile phones? And just keeping an eye on specifically on that and other issues that would have occurred the minute we moved into lockdown. And there will be issues in this going forward, because although some people are now back in the banks, there may be splits down A teams and B teams, etc., etc. We need to make sure, people will need to make sure that communications are kept as exact as possible between all these different teams. And just to summarize at the end here, as well as the equity and ETFs that I've been going through, we have access to multiple number of subject matter experts with decades of trading knowledge in other products, and we'd be very happy to discuss these as well going forward. Thank you very much for listening.
Right, thank you, Damien. Make sure that I'm back on.
Yeah, I can hear you okay, thank you.
Can you hear me? Let me start my video. Right, thank you very much. That was a very detailed overview. So thank you very much. I've had a couple of questions come in. So let's just crack on with those first. The first one is, how well did traders manage the sudden shift to dealing from home?
Well, yeah, actually, a few weeks after lockdown had struck, I called around a fair few of my old friends who are still in the market to confirm really what they were up to. I mean, most confirmed obviously that they had moved to work from home. I think the initial thought was a lot of banks might have kept staff in the building, but the bulk of people had moved to work from home. Most had said that the transition had been better than they probably initially thought it would be, and I think if we'd hit this virus sort of 5-10 years ago, that we would have been in all sorts of trouble, and communications have improved tremendously since then. And I think a lot of people have, were already set up to have IP phones, I think internet protocol firms, so they could link in quickly and via phones. But I think some people did struggle, because I think the communication side of things is much harder when you're working from home. It's very easy in a bank. When a trade's going on, there's a lot of discussion going on the floor, et cetera, et cetera. You can, easily get a feel for what's happening. Whereas if everyone's split into different pods, it's much harder to get a feel. A lot of stuff is going through on Bloomberg chats, as you'd expect. Sometimes too much information, sometimes not enough information. And certainly one person I did speak to said that they had, in the really volatile times just after lockdown, had troubles sending out confirmations to people, and people misconfirming trades or people not confirming trades, just because the volume of stuff that was going through and the limited bandwidth they had at home was an issue. But I think people found it better than they thought, I think, generally. And I think some controls were relaxed to help banks initially, and I think those were all then reimposed pretty fast. But yeah, I think it was better than people thought. Communications has been an issue. I think the classic Zoom call, etc., that we're on now have not really been conducive to efficient trading, and also home broadband is just not set up to have the speed and resilience that you would find on the big broadband pipes that you would get on an internal network within a bank. So I think people have coped okay, but as now, that's not really an excuse now. I think that now this is seen as the new norm, and people have had to go back and look at what controls were put in place, what controls might have been relaxed and then put back in place rapidly to keep control of what happened back then and what is now going on today.
I mean, would also be a concern possibly that who you're locked down with, because obviously you're in your
yes.
confidentiality of things you're discussing or trades, and then someone in the house, I don't know, family member you're locked down with, you normally wouldn't have a clue what you were doing on trade. So
yes, I think that's very true. Husband and wives working for competing banks, there's big issues there, obviously, especially if maybe one's in a corporate finance department and one's in a trading department, or just people in flat shares, possibly working at different institutions. There's a lot of information that would tend to stick within a financial institution and is private information that would not normally be released outside of those four walls. And obviously a lot of this stuff now has been. So, people have to be careful about what is said, what might get printed off. Stuff should theoretically not be allowed to be printed off, for example. So yeah, that is definitely was an issue, I think.
Okay, a couple more questions here then. What are the challenges of documenting, testing and implementing new normal trading procedures?
I mean, because this has all happened so rapidly, that it is a massive challenge, really, all of that, because normally a lot of these things would be rolled out slowly, they'd be tested across many months, and we've moved to this environment so rapidly that maybe some things will have slipped through the net. I was thinking earlier about, you know, if someone gives you an order that you would then shout through to a trader and he'd start executing, but then you struggle to get that order in. Now, why fix and everything is so useful is that everything gets timestamped. But if an order goes in late and then you're starting to execute against it, there's a break in that. And how do you keep on top of that? You need to really have made sure that all these things were put in place. And so I think going forward, it's going to be hard to get all this testing and stuff done in such a short period of time. So hopefully banks will be on top of this and be able to do it quickly.
Okay, one more, but I think you may have sort of covered this, but do you think investors knew what the ETF was when trading USO?
I think a lot of investors won't have known what it is. I think a lot of investors in that, USO works fine if you're trading on a sort of day trading basis. So it would attempt to replicate the percentage move in oil on that specific day. But actually, if you're holding any futures type ETF over any sort of long period of time, you are subject to the vagaries of the roll, as it were, of the difference in pricing between contracts. And I think a lot of people won't have been aware of that. I think, is there a case for mis-selling there? I think there probably will be. And I certainly know that there's a fair few lawsuits flying around about the USO at the moment, much more to do with the fact that it's completely changed its mandate from where it was before, because it's had to trade not just in the front month now going forward, it's had to trade across multiple expiry dates. And it's also, I think, having just been trading West Texas before, is now trading a bit of Brent crude. So its entire benchmark really has changed. So there is quite a lot to answer there, really, about what's gone on. And I think a lot of investors won't really have known. I think they'd have seen oil on the tin and thought, well, actually, my view is, the oil price is going up. I want exposure to that. And they won't have got anything like the exposure that they expected. But this is true. This has been true over multiple years. I certainly remember speaking to a friend years and years ago who'd bought a natural gas ETF. Natural gas is a commodity you kind of want to stay clear of, because it always has issues with big jumps in price between contract expiries. And he'd bought it, nat gas had gone up, but he'd made no money, and that is because you can get really screwed over by the roll in these things. So I think there will be issues in this. It does, it's a slight buyer beware on some ETFs. I think people need to be aware of what these things invest in, if they happen to have physical or synthetic replication underneath them, et cetera, et cetera. I mean, sensible, smart people will be doing this, but I think with the rise that we're seeing, certainly in the United States, of all this day trading, people will need to be aware of what these things are. I mean, it may be fine in a market that's going up day by day by day, but it's certainly when the market stops, there'll be some there could be some interesting issues that get unveiled.
Okay, thank you very much. Right, I don't seem we have any further questions. Thank you very much, Damien. Thank you for our attendees. If you have any further questions, you all have my email address and Damien's contact details. So thank you very much for joining this afternoon, and hope to speak to you soon. Thank you. Bye-bye.